Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Eric Clark, CIO at AccuVest and portfolio manager of the Alpha Brands Consumption Leaders ETF. The ticker symbol is LOGO, very interesting ticker symbol. And we've got some very interesting topics lined up today, from the companies leading the next phase of AI enablement to the state of the US consumer and why investing in brands you trust really matters. Eric, welcome. Great to have you with us today.
Thanks, Neena. Great to be with you. Happy Friday.
Happy Friday. So let's start with the beneficiaries of the next phase of the AI build out, because we know tech giants have been spending hundreds of billions of dollars on AI data centers. But lately, there has been a lot of chatter and concern about whether this is turning into a speculative bubble. And people are starting to ask, how will all of this actually pay off? And I came across an interesting note on your website about the next phase of AI enablement. So it basically said that while chips and hyperscalers, chip companies and hyperscalers, they have dominated early returns, the next phase of value creation will come from AI's application across traditional industries and sectors. So tell us more about that. What is the next phase of AI enablement, and who do you see as the main beneficiaries?
Yeah, it's a great place to start. Obviously, the bulk of the returns thus far from AI have really accrued to the semiconductors, the NVIDIAs of the world, all those names re-rated as the amount of compute that needed to be bought and implemented, plus the data center build out and the power generation and the names that are part of that from an industrial and electric grid perspective. That's kind of where it's all accrued thus far. But if you think about this, if you look at the long game of AI, this is about every consumer, every business being able to implement some form of AI for their personal benefit, for the business and the enterprise. And that part of it, from an investment perspective, really hasn't occurred. I mean, you don't see it in the stock price appreciation. I mean, this year, as most people know, it's been an incredibly narrow market of returns. I think I follow Liz Ann Saunders from Schwab, and she puts out lots of great charts, but one of them is every week they talk about, what percentage of the total gains of the total companies in the S&P are outperforming the S&P, and it's like 15% over the last 12 months. So it's been a very narrow market because money has clustered in to the phase one of the AI build out. But we're really focused on what companies will benefit when they start rolling out AI. And we're already hearing that on conference calls the last 2 quarters, really. I mean, Walmart's a good example. 4 years ago, they were doing things before people were talking about AI. They were implementing technology into their business to help efficiency gains and get more engagement. And that's translated into a really expanding multiple and a stock that's been a terrific performer, kind of not your grandpa's Walmart into, a more tech-enabled Walmart. So, we certainly think that digitally native businesses, platform businesses, companies with a massive amount of consumer data are the first places that AI enablement really happens and where those re-ratings happen. And, data is just a big word, but it needs to be clean data. It needs to be organized data, which is why things like Snowflake and other brands are also kind of innovator brands are doing really well. But once that happens, then you have some real amazing re-ratings. And we saw it last quarter with Shopify, a stock that we own. Obviously, they're providing the IT infrastructure for merchants all over the world to enable e-commerce capabilities and logistics, et cetera. So, we've already seen some of that re-rating happen when that aha moment in an earnings call from companies that were early in that deployment phase started to do that and then started to see better results, better margins, better cash flow. Revenue to employee is a great metric that we love to look at. And when that starts to expand, meaning the company's being more efficient and doing more with less, that's when you get those comments like Walmart has been talking about profits growing faster than earnings or than sales, excuse me. So the EPS line will start to see a lot of those benefits. So that's really where we're focused. And not every company's going to be going to have the the benefits kind of evenly. Some companies, like I said, if you're digitally native, tech is at the core of what you do, e-commerce, and you're a platform business, those are ones that we think are, some of the first enablers. So it could be a consumer-focused business, or it could be an enterprise-focused business like a ServiceNow, which we love and is in the top holdings. We've heard that some of that on their earnings calls. We heard it in Intuit's Investor Day a couple of weeks ago. Data and AI is at the center of what they're doing. So the benefits of that are to come. And, the market hasn't really invested in those names because they've kind of lagged this year, and that's okay. We're getting to the party early, so we have a good seat because we expect the future quarters to be, outsized relative to consensus expectations, and that tends to be when the re-ratings happen.
So you talked a little bit about Walmart, Shopify, and ServiceNow, how these companies are leading the charge in deploying AI-powered efficiencies. On your website, you also have some case studies, some really interesting real-world examples where AI is already driving measurable results. Tell us about some of those case studies.
Yeah, sure. I mean, when we were thinking about this theme and where to allocate, you want to see intuitively what should make sense from an AI deployment and benefiting a company, and then obviously you listen to corporate earnings, et cetera. And so you definitely heard it, for instance, in Netflix and in Spotify. Again, they all qualify for that kind of digitally native businesses. So that's why I kind of started from there, because there is some things that rhyme across these earnings calls. But, if you're Netflix and you thrive on more consumer engagement with the app and viewership, that certainly affects your ad revenue. If you can understand us better as consumers and clients, then you can push us information and content that we want and need, which drives more engagement, which in the end allows you to push prices, so that expands your pricing power. And it also pushes your margins and your free cash flow. And so all the operating metrics improve. And we know when operating metrics improve, your multiple gets to expand. And that's the magic that happens in a stock when it goes from X to X plus, when all those metrics, kind of change. So whether it's Spotify with their automated DJ, which drives more engagement, which makes me search for more things, which, allows artists to make more money, which then feeds into me wanting to go to live concerts. We own Live Nation. So there's a lot of things that are tied to this that we've talked about. And I think we use Walmart, we used Amazon. Obviously, Amazon and Walmart have very similar businesses. Amazon, certainly from a logistics perspective, and I would say a lot of retailers also qualify logistics help, robotics in the warehouse, agents for customer service. There's just so much of a business that can be enhanced. And, I'm hearing one thing very, very consistently across calls, and that is we think we can continue to grow as fast or faster and keep headcount flat to down. And so obviously that has a big impact on margins too. So there's just plenty of first and second and third derivative opportunities in AI when most people are strictly focused on, the most obvious phase ones.
So now let's talk about the US consumer. And we watch consumers spending very closely because that makes up about 2/3 of the US GDP. And it seems that so far, the American consumer has remained resilient, surprisingly, despite high inflation and almost frozen jobs market. That said, it seems that they are also becoming a lot more value conscious. And that has become even more important now because probably many retailers will start passing on at least some of the new tariff cost on to the consumers. So tell us, how has consumer sentiment and household spending been shifting lately? And as these tariffs start filtering through to prices, which companies do you expect to remain resilient?
Yeah, it's a great question. I mean, I'll even go back a little bit further. The pandemic really forced consumers to change behavior. And that's really hard. When we get comfortable with something and it becomes part of our everyday life and our muscle memory, it's really hard to change that. A real big outside force needs to come in to change that. And so the pandemic obviously forced us to shop in certain ways with certain companies that were open versus others that weren't. Let's say travel, for instance, for a while. And so, when you change your behavior and you have a good experience, that you build new muscle memory. And so with all the supply chain disruptions, and then we had the inflation that came from the pandemic, and that changed behavior as well. And that put some pressure on people's wallets. At first we don't really love being charged more for everything, but we understood given the pandemic and the supply chains, et cetera. After a while, people they get fed up with it and they say, I'm going to vote with this company or this industry with a no. And that means I'm not going to go shop there anymore. And I'm going to search for a better value. And so again, that's driven more behavior into, loyalty towards Walmart and towards Amazon and towards Costco and TJ Maxx and Ross stores for the value. And we certainly see that accelerating with the tariffs. And so, unfortunately, we do not have broad consumer spending where people at the upper income cohort are still spending and feeling good, same as the people in the lower income cohort. It's really the bottom 2/3 of the economy from a consumer spending perspective that are very stretched and somewhat disenfranchised and are really focused on tightening their belt, trading down where they can, trying to get by. More people are taking second jobs, Uber driving, et cetera, just to try to pay for everything that's costing more. And so there is a bit of a bifurcation, this K-shaped economy that people are talking about, where at the upper end of the K, you have people that have higher incomes, that have home ownership, that have big stock portfolios that have really benefited. So while they don't love spending more on every category, they at least can if they need to and want to. And even at the top end, we're seeing those consumers be somewhat conscious of cost. Walmart has certainly been talking in multiple quarters now that the $150,000 income customer has been dipping down and engaging with Walmart more than they ever have. And so, you do have this bifurcated economy, and we kind of think that continues with all the actions that the administration's taking with trying to nearshore and onshoring and trying to do more manufacturing closer to home or in the U.S. That's going to put more pressure on prices for everyday items. I mean, we're talking about doing that with furniture, built in North Carolina, for instance, versus in Vietnam. Obviously, things are going to be more expensive. So all along the supply chain, people are going to have to absorb some of that additional cost. The consumer is part of that, kind of must absorb some of that cost. It'll be across the vendors and the companies that sell. And again, that's going to drive more AI deployment because they need to kind of make up that extra cost somewhere. So they're going to do it through headcount cuts. They're going to do it through AI deployments to try to offset some of the margin erosion that might come from higher prices. So, what normally we would be much more broad across all of the consumer spending categories. But because consumers aren't spending broadly and are deferring some things and in many cases focus more on needs, than wants. We're a little more concentrated, and certainly, our view of 2026 now that rate cuts are beginning, and I think will have to be accelerated as the labor market cools off a little bit, and maybe the economy cools a little bit. The economy should reaccelerate into 2026. That should drive better consumer sentiment, which will drive a more broad-based economy where money moves from where it's clustered now in just tech and semiconductors into other industries. So we certainly are looking forward to getting more broad across certain spending categories. We've just started that with adding some Chipotle, which is, had a really difficult 12 months. We've done it in some energy drinks with Celsius, and I anticipate doing it a little bit more in some retailers too.
I agree with you. It's just been a tale of two consumers, and unfortunately, lower income consumers are facing a lot of difficulties now. Now, let's talk about your ETF. Excellent ticker symbol logo. So, tell us, what is the philosophy behind owning the brands that you trust?
Yeah, it's funny. I was really surprised. I thought, let's just try to see if logo's available, and there it was. So, yeah, it's just one of those wonderful symbols to so somebody knows instantly that we're talking about probably the consumer and brands in particular. But I was brainwashed very early in my career with Peter Lynch. Peter Lynch. He wrote the book One Up on Wall Street. I've always been a big investor in companies that I understood. And that one main category, Josh Brown from, I forget the name of his firm.
Ritholtz.
Yes, Ritholtz. He recently interviewed Peter Lynch, which I thought was a terrific interview.
That was an excellent interview.
And one of the things he said was, listen, it isn't necessarily about, owning what you know in the good times, right? It's what happens to people's brain when the markets are difficult. If you don't know what you own, you tend not to stick around. And we know that the best gains from equities come when you're committed to equities, and certainly when you're committed to buying more of what you own when things are down. And so there is this, my view early in 2015 when AccuVest and I got together over this theme was that, most investors just don't have any dedication to the largest theme driving every major economy. And that's consumer spending. It's 60 plus trillion a year. It's pretty stable. I mean, even in a pandemic, when we shut the whole world down, somehow consumers figure out a way to spend money. And so the brands that we favor, the ones that seem to rise to the top in all the important spending categories, those companies just tend to be wonderful businesses. They tend to have really good operating metrics, good brand love, good stability, good brand loyalty. And so if you stay relevant and you're in a really important category, you tend to be a pretty good stock over the long term. And now, yes, there can be things like the pandemic and inflation and supply chain disruptions that kind of get in the way of some of that short term. But in the end, consumer spending is given its size and its predictability, it really deserves to be in a portfolio. And most people just don't have any dedication to it, which is why we created Logo in the first place. And so the logic behind owning the brands that you trust is, think about what a wonderful hedge it is, right? We spend, if we're going to go, research a trip and we go on booking.com and we make that we get a good deal for the prices, for the travel that we want, and we have a good experience, and they're now deploying AI that's going to make our experience even better, give us great ideas. We're going to stay loyal to that. And so we spend with that brand. But what if we identify that brand really is the dominant brand and the category is really, really dominant and important? Maybe we put some of our investment dollars there. So as we spend, and because of our loyalty, but we put that money in the stock and we make money on the stock over time, that essentially is a wonderful hedge to our spending. And so, that to me, that really is one, you have to have the dedication to the theme. You're not getting it with the passive indexes, and therefore you're not getting it with most of your active funds that are, kind of benchmark hugging or benchmark aware. And the reason for that is most brands live in different sectors than are the largest sectors in the indexes. So consumer discretionary, consumer staples, communication services, and even financial services. A lot of the brands that we recognize and that we utilize on a day-to-day basis are in sectors that are underrepresented in most of the indexes. And so the logo is a wonderful complement to the SPY or whatever, passive indexes you use, because it's giving you, some different exposures that are tied to a really important theme driving the global economy. And that's really why we built Logo in the first place.
Makes a lot of sense. And I'm looking at the top holdings: Amazon, Uber, ServiceNow, Netflix, Costco, Walmart, then Microsoft, TJX, and Apple. These are the top holdings in the ETF. And you've already talked about some of these companies and how they are using AI for greater efficiencies. Anything else you'd like to add about these holdings?
One thing I'd love to add is, because sometimes people, and I just had this conversation with an advisor the other day, he said, listen, I get the Walmart and the Amazon, et cetera, but why do you have some financials in there? Let's call it Blackstone, KKR, Apollo, and lifetime spending and consumption. If you think about it, over time, we earn, we save, and we spend, and we invest our money for the future. So when we retire, we have some capital. And the biggest theme in financial services and asset management in the investment theme is money migrating on the margin away from public fixed income and equities and into privates. And the dominant brands in those categories are Blackstone, KKR, Apollo in particular. And right now, those stocks are on mega sale for the last 3 weeks. They have been getting sold off. But we see this massive opportunity for more people to get engaged as they put money to work, not only with public markets, but privates. Because if you think about it, the bulk of the opportunities isn't public. 90% of the companies out there are private, and yet very few people have any exposure to private companies. And so having some of that exposure to some of the best, smartest investors around the world in these companies seems to make a lot of sense. All of them have significantly outperformed the S&P 500 since they've been public companies. You do have to absorb some of the volatility along the way because they're private and they have some leverage embedded in them. But, long term, great investors, great access to capital, raising such amazing amounts of money in the private wealth channel, with incredible dry powders currently to put to work into any down markets or periods. That area looks really attractive to us. And if your base case, and this is our base case, if your base case is that the Fed will start cutting rates, the economy will reaccelerate after a couple of tough years of really a rolling recession around the world, ISM data will start to go up through 50, which hasn't happened, save a few months here and there for the last couple of years. That is going to drive much better consumer sentiment. It's going to have a lower cost of capital. The M&A market is going to heat up again, and that's a great environment for the private asset managers. So you're getting a really good opportunity to buy some of these stocks on sale, whereas some of the other ones are still at all-time highs, although we still think the re-rating due to the AI deployment theme is to come. So, between the ServiceNows and, those business enablers with the Intuits and the Walmarts and the Amazons and the Uber building the super app, there's such a great opportunity to invest in some names that you're really not getting much exposure to, if at all, when you're in the passive world.
Very interesting. I want to briefly talk about a stock which is actually not a holding in your ETF. It's Oracle. And we know that Oracle had surged recently after the company revealed a huge backlog of contract revenue that it expects to collect. And that even made Larry Ellison the richest person in the world, briefly surpassing Elon Musk. But since then, Oracle has given up some of those gains because concerns have emerged about its capital spending plans and leverage, and it has posted negative free cash flow in 3 of the last 4 quarters. So we'll learn more at Oracle's upcoming Investor Day, I think next Thursday. But I believe you are bullish on Oracle. Tell us why.
Well, we don't own Oracle, but I am watching from afar. I mean, listen, Larry Ellison is not the top 3 richest person in the world for no reason, right? He has been a stalwart in technology trends for many, many decades. And nobody can dispute his commitment, right? He is willing to take on a massive amount of debt to kind of push the boundaries a little bit from even potentially being downgraded to junk debt, which I don't think will happen. But certainly his view of, as inference becomes the next wave of AI and importance, the data center play is really important. He's certainly banking on the future of Oracle. And now, candidly, he might see so much disruption in Oracle's core business that he's viewing this as, I must do this. It's hard to say for sure, but I agree with you. The analyst day, they're certainly at least going to put their front feet forward and show people the math of why they think this risk is worth taking. And I sincerely hope that it works out. It's really interesting. So many companies are tied to the success of OpenAI in particular. OpenAI can't succeed, which means the AI revolution can't succeed unless all of these companies around AI, attached to AI, provide them with funding, provide them with computing power, provide them with the ability to get all of the power generation, et cetera. And so there's a lot of companies tethered to OpenAI, and there's a lot of commitments that OpenAI has made, including to Oracle and with Oracle, that are somewhat risky over time. And so we're watching from the cheap seats on Oracle in particular. I just have a lot more comfort in things like ServiceNow and Intuit that are kind of not yet re-rated versus seeing an Oracle who has already re-rated. Now, having said that, my view of let's assume that AI is an actual bubble. What happens into bubbles in general? Wild evaluations happen. So I would certainly expect Oracle, before this is all over, to be $1 trillion market cap. If this is indeed the definition of a bubble where you see these kinds of things, it certainly feels like the $1 trillion mark is certainly one of those entry points for companies that are all part of that bubble. I've already said publicly that Walmart certainly deserves to be part of the $1 trillion club with 600 or 700 billion in revenue. So, we'll see. We don't own Oracle currently because of the amount of debt and the fact that they're willing to go negative free cash flow, which is not something we like. We own Microsoft and Amazon and Google and those names, and those guys have certainly been willing to eat into their free cash flow. What I do worry about is how long, is this an insatiable appetite for cash that just in perpetuity causes these companies to pull their free cash flow down for longer periods of time? If yes, I do not think the market is going to reward those companies like they did. And maybe we're starting to see that with some of the underperformance in Amazon, underperformance in Microsoft as well. I just don't think the market has an appetite for a forever just burning of free cash flow without any evidence of a really strong ROI. Thus far, we're getting good AI related revenues, but that really needs to compound given the amount of money that's being spent across the board in the tech stack for AI. So that one's going to be interesting to watch. And what we do know, when there is a concern about something, a really crowded trade unwinds really quickly and often with a lot of oomph, if you will, a technical term. So, we'll see it. We'll see how all this goes. But I do feel pretty good about the consumer names that most people aren't focused on right now. Certainly if that happens.
Good stuff, Eric. We'll have to leave it there. But thank you so much for joining us today and for sharing your insights.
Absolutely, Nina. Really appreciate your time. And for those out there that if they want to get more information on the ETF, it's logoetf.com. You could certainly reach out to me. There's a little button on there if you want to chat more about it. I'm always happy to chat consumer or this strategy, et cetera, et cetera. So I really appreciate your time.
That was Eric Clark, CIO at AccuVest. And the ticker symbol of the ETF is LOGO, LOGO, very easy to remember. He talked about some of the top holdings in the ETF and why he likes them. He talked a lot about Walmart. The ticker symbol is WMT. Costco, the ticker symbol is COST, COST. He mentioned Uber. The ticker symbol is Uber, UBER. Netflix is NFLX. He mentioned Blackstone. The ticker symbol is BX, and KKR, the ticker symbol is KKR. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.